Hi, my name's Paulo of ClearPoint Retirement Solutions, and I'm going to review what asset allocation is and how choosing the right asset allocation helps make sure that your investment portfolio is a good match for your risk tolerance. Many industry experts agree that choosing the right asset allocation is the most important decision you can make as an investor. But if it's so important, then what is it? On a basic level, your asset allocation describes how the money in your investment account is split between three main asset classes: cash, a risk-free investment with no chance of decreasing but a low rate of return; fixed income, low-risk investments such as bonds that provide consistent returns; and equity, which is ownership in companies, better known as stocks or shares. As a Canadian who loves hockey, I thought it would be fitting to describe these three types of assets and how they work together as hockey positions. Cash acts like the goalie. It doesn't move a whole lot, but it's stable and its main job is to protect your initial investment. Fixed income acts like a defensive pair. It protects your portfolio against large drops when the stock markets aren't doing so well. And equity acts like a forward line. It's high performing and often scoring, giving you higher investment returns when the markets are doing well. When it comes to building a portfolio, your asset allocation should reflect how much risk you're comfortable taking with your investments. While most years are expected to have positive returns, negative returns do occur from time to time. The more risk you're willing to take, the better your investment returns will be over time. But keep in mind that those higher returns come with a lot more volatility because higher risk investments tend to go up and down in value a lot more than lower risk investments. The theory is that the further away you are from needing your money, the more risk you can afford to take with your investments. The reality is that not every 25-year-old is comfortable with lots of risk, and not every 55-year-old wants to be more conservative. A simple way to figure out how much risk you're comfortable with is to ask yourself this question. On a scale of 0 to 10, how comfortable are you with investment risk? 0 being you wouldn't want to see your investment dip a single cent, 10 being you are comfortable seeing your investments go up or down 30% with the hope of having above average returns in the long run. Once you've given yourself a number, let's bring this back to hockey. Think of yourself like the coach of your investment portfolio. How much risk are you willing to take to reach your investment goals? Do you want your portfolio to be more offensive or defensive? If you're in the middle of your working career with at least 20 years to go until retirement and a large unfulfilled retirement goal, you might want to take a more offensive approach in order to achieve your investment goal. So you might give yourself a 9 or a 10. Or perhaps you're nearing retirement and getting ready to start withdrawing from your retirement accounts. In that case, you might want to take a more defensive approach to reduce your market risk. So you might give yourself a 2 or a 3. Once you've figured out which number matches your risk tolerance, you can start building your portfolio by allocating a certain percentage of assets to cash, fixed income, and equity, based on your appetite for risk. For example, if you said 0, the best option for you would be to stick to a cash option like a GIA, short for Guaranteed Investment Account. If you gave yourself a 1 or a 2, a conservative mix would be appropriate: 10% cash, 70% fixed income, and 20% equity. If you gave yourself a 3 or a 4, a moderate mix would be 10% cash, 50% fixed income, and 40% equity. If you gave yourself a 5 or a 6, a balanced mix would be 5% cash, 35% fixed income, and 60% equity. For a 7 or 8, a growth mix of 20% fixed income and 80% equity would be a good fit. And if you gave yourself a 9 or a 10, an aggressive mix with 100% of your portfolio invested in equity might suit you best. This is the riskiest asset allocation because having all of your money invested in the markets means that your portfolio is the most sensitive to market changes. Keep in mind that being the coach of your investment portfolio means that you're not only responsible for putting together an asset mix that matches your risk tolerance, you're also responsible for making sure that the balance of defensive and offensive investments stay in line with your goals and risk tolerance. That means being on the bench, monitoring the play, and making all the line changes and substitutions as needed. Now, not everyone wants to be the coach, and even those people who like coaching don't always have the time to do it. So if you want your money to work hard for you, but you'd rather be just a fan and enjoy the game from the stands rather than sitting on the bench, you can choose a pre-built portfolio and let the fund manager do all the coaching. The easiest way to do this is by choosing either an asset allocation fund or a target date fund. And if you want more information about these options and how to choose the one that's right for you, we have 2 short animated videos on our website at clearpointbenefits.com/videos. I hope this video helped you get a better understanding of what asset allocation is, why it's important, and how to apply it to your own investment portfolio. If you have any questions about this video, your group retirement plan, or your personal finances, don't hesitate to reach out to the team at ClearPoint Retirement Solutions, and we'll be happy to help you.